Hello everyone, thanks for watching my video. The goal of this channel is to help you to have a better understanding of investing. If you're new to this channel, you can turn on the notification on the bottom right side of the YouTube page so you will know when the new content comes out. Please smash the subscription button also for your own benefit. Content of this video and this channel are not construed as investment advice. We're not liable for investment loss of your investment decisions after you have watched this video. You need to find a qualified investment advisor or financial advisor to help you to formulate a better investment strategy. Today I'm going to talk about the direction of the stock market, whether the Fed raising interest rate is bad for the stock market based on many very important historical data, and then some Tesla related news. So please stay tuned. The S&P 500 closed down 4.53 points at 4,696.05, while the Nasdaq closed down 19.31 points at 15,080.87. The Russell 2000 closed up 12.37 points at 2,206.37. Yesterday, ADP, which reports the private sector monthly employment data, reported that the private job growth totaled 807,000 for December 2021, well ahead of the estimate of 375,000. The hiring was broad-based, though leisure and hospitality led with 246,000 new positions. Yesterday's ADP report indicates a strong December job report this Friday. A strong job report is a double-edged sword. It might cause the bond yield to rise and then cause the stock market to drop. However, a strong job report also indicates that the upcoming earnings report will be better than expected. Yesterday's ADP report was overshadowed by the release of the December 2021 Fed minutes, which caused one of the biggest stock market drops since early 2021. The big drop of both S&P 500 and Nasdaq was caused by the strong language in the Fed minutes and potentially early Fed rate hikes as early as March 2022. The Federal Reserve announced that it would move more quickly to pare back its pandemic-era easy money policies as Fed officials grow concerned about the persistence of inflationary pressures. FOMC said it would double the pace by which it wound down its asset purchase program. I think yesterday's major sell-off was just normally profit-taking. The Fed minutes were just an excuse. For example, Apple and Microsoft were up big last year. Normally, investors want to hold on to the winners at year-end so they do not need to pay taxes. Then, as the new year comes, they sell those stocks that have gone up too much last year. So far, the sell-offs from stocks like Apple and Microsoft are just profit-takings. The stock chart of QQQ shows that at the end of last year, it was overbought and hit resistance of 404. The sharp sell-offs last few days has dropped the QQQ to 384. The QQQ is still overbought but looks healthier than before. Will the stock market tank when the Fed begins to raise interest rates? The answer is no. Historically, when the Fed begins to raise interest rate, it means that the economy is too strong and the companies are making too much money. The stock market will continue to perform well. If the Fed raises interest rate too much, causing short-term interest rate in line with long-term government bond yield, which is called flattened yield curve, or short-term Fed fund rate higher than long-term bond yield, which is called inverted yield curve. Both flat yield curve or inverted yield curve will cause the economy to slow down too much, then the stock market will go down. The 2000, 2008, and the 2018 stock market corrections were all caused by the strong Federal Reserve action. As you can see here, the yield curve was inverted as of January 2001 even after a huge Nasdaq sell-offs in 2000. The yield curve in most of 2002 was flat. Same thing happened in 2007 when yield curve was inverted in January 2007 when the Fed was fighting the overheated economy. On December 15, 2016, the Fed began to raise the Fed fund rate. Then the QQQ was $120.04, and then the 20-year government bond was 2.89%. QQQ topped at 186.74 August 29, 2018 with a gain of 55.1% when the Fed fund rate was 1.92% and 20-year bond yield at 2.96%. After QQQ peaked, it dropped about 20%. From the lessons we have learned last 20 years, the stock market will suffer with a flat or inverted yield curve. Right now, the Federal Reserve has not raised the Fed fund rate, and we have a steepening yield curve, which is good for the economy and the corporate earnings. And normally, stock market rises in such a normal yield curve environment. Tomorrow, the December 2021 employment report will come out. The ADP indicates that we might have a strong job report. I do not know what will happen to the stock market tomorrow. After tomorrow's job report, investors will focus on the strong earnings season. So at worst, we expect to see the market begin to rise next week. In the longer term, we need to pay attention to how fast the Federal Reserve is raising the interest rate. Right now, with the normal yield curve, any pullback is a buying opportunity. Tesla has corrected to more than 15% after it reported a strong 4Q 2021 delivery and production. I'm still holding a significant amount of Tesla shares and believe Tesla will be the best performing stock in year 2022 and beyond. You can watch my prior videos about why I like Tesla stock. Unless we are close to a flattened yield curve, I believe the stock market will keep going up. However, please do not use too much margin since the market is going to be very volatile. Buying on dips will be rewarded in this volatile environment. If you like my video, please leave a like on the video. It will help the YouTube algorithm to push the video to reach more people. If you want me to cover something you are interested in, please leave a comment. You are also free to upload the video to anywhere you want if you feel it might be helpful to the others. Your support is appreciated.